The opinions expressed by Karen Scott Mims and the guests on this podcast are their own and do not reflect the opinions of this podcast platform. All statements and opinions expressed are based upon information that's considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risks and, unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendation appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor whom you have specifically retained to determine if it's suitable for your specific situation. This podcast is designed to provide accurate and authoritative information with regard to the subjects covered. Investment advisory services are offered through Brookstone Capital Management, LLC, a registered investment advisor. BCM and Harbor Point Wealth Management are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. Income regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. Income regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance products and guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone Capital Management. Most people simply ignore taxation through the 4 phases of your wealth. Instead of understanding the 3 tax buckets, you arrive at retirement with a huge 401k in the tax-deferred bucket and ignore the taxable and, most importantly, the tax-free bucket. How can the middle-class millionaire, average Joe and Jane, be so unprepared about how to protect their wealth using tax loopholes like the wealthy 1%ers do? Easy. Welcome to the Tax Smart, Tax Zero podcast. This is a show about tax-free wealth. Financial advisors sell rate of return. Annuity salesmen sell what else? Annuities. And part-time tax preparers sell a 1040 to submit on April 15th. But the real goal is to implement strategic tax planning. We invite you to take the journey and explore the path to the 0% tax bracket. It's time to divorce Uncle Sam from your wealth. And now, your host, noted tax attorney and private wealth strategist, Karen Scott Mims, Esquire.
Hello, everyone. Welcome to another episode of Tax Smart, Tax Zero, the path to the 0% tax bracket. I am your host, Karen Scott Mims. Thank you so much for joining us today. Well, we have an absolutely fabulous show for you today. Our show is entitled The Last Will and Testament That Won't, introducing the concept of tax-based estate planning. So I will start by saying this is a show about planning. And it's not that most plans fail, it's that most people fail to plan. So if you are a regular listener of our show, you know that when we utter the words retirement planning, it has a very different meaning for us. So for example, it means taking a coordinated and calculated approach to income, investments, cash flow and budgeting, Social Security, Medicare, and long-term care to start. It also means recognizing that you have to make intelligent and informed decisions about real estate in retirement, risk management, and let's not forget about estate planning, asset protection, charitable and philanthropic giving. Because I would like to say to you, I think that it's the end, and we should consider an end to the whole idea of checkbook philanthropy, right? Because I think that if we could understand, in all honesty, how to have a more strategic approach to dealing with our charitable and philanthropic endeavors, I think that a couple of things would happen. Number one, the charity would get a lot more money, right? So pick your favorite 501c3 and then imagine that they get a lot more money, right? Number two, imagine that we don't have to qualify by actually jumping through the hoops that you have to jump through in order to get that charitable deduction on Schedule A. And then number three, imagine that we end up paying a tremendously lower amount in taxes. In case you have just joined us, you of course are listening to another episode of Tax Smart, Tax Zero. I am your host, Karen Scott Mims, tax attorney, registered investment advisor representative, accountant, estate planner, and certainly my favorite role, private wealth and tax strategist. So our show for today is entitled The Last Will and Testament That Won't, introducing the concept of tax-based estate planning. So it's interesting. When we think about the old way, that's having a basic last will and testament. If we were in 1970s and we were doing 1970s style retirement planning, it was very simple, right? Here's the concept. You're age 60, you leave the company that you've worked at for 35 years, you receive a gold watch, you live off of your pension and Social Security with a life expectancy of 65. Case closed. Done. If you do the math, it would seem that despite paying a lot of money into Social Security, you don't withdraw a lot of benefit, right? You only withdraw benefits for a couple of years before the end of your life expectancy. That's a different subject for a different show, because one of the things I want to emphasize is that sleeping on Social Security, right? That's kind of one of the biggest mistakes that you are going to make when it comes to retirement. But we'll talk about that on another show. Estate planning, if you did it at all, was very simple. So you executed a last will and testament, you left everything to your spouse did the same thing, left everything to you. We kind of call those sweetheart wills. And even though no one understood the terms primary beneficiary versus contingent beneficiary, what would happen is that like mom and dad would die, the estates were never probated, the siblings couldn't agree, and the telephone bill still came in dad's name, although he died 20 years ago. Okay, anyway, fast forward, now we're in estate planning in the 90s, right? So people began to understand that estate planning documents really include two sets of documents. There's one set of documents nominating an agent to act on your behalf in case of incapacity or to express your wishes about life support, right? And then there's a second set of documents for dispositive provisions related to wealth transfer. I will also say that there are two methodologies. So there's a last will and testament-based plan and there's a trust-based estate plan. Let me explain to you why I'm not a fan of the last will and testament-based plan, right? Reason number one, applicable and slightly useful only in those instances in which your balance sheet consisted of a small bank account, right? $5,000 and a modest home that you excitedly paid off before retirement because after working 35 years at a job in which you were underpaid and underappreciated, it was kind of the one thing that you could show for the little bit of money that represented the little bit of wealth that you had, right? Reason number two, it still makes you go through the probate or estate administration process. It's just that if asked, what did the decedent have or want, you had a piece of paper, right, as an answer rather than a blank stare. And then reason number three, why I'm not so fond of this last will and testament-based plan, it only provides for outright distribution. And that is rarely going to work among two or more people because I can tell you there is no such thing as a half of a house. Two different people will have two different ideas about one house. Hello, estate litigation. And in some instances, it can be very dangerous according to who the beneficiary is, right? Because one of the things that you've heard me say before, we often confuse great people with being great beneficiaries. They are not the same thing. In case you have just joined us, you of course are listening to another episode of Tax Smart Tax Zero, the path to the 0% tax bracket. Our show for today is entitled The Last Will and Testament That Won't, introducing the concept of the tax-based estate plan. So imagine, if you will, that we have set a goal of forming a community of people that we could educate constantly about retirement planning and help them look beyond their portfolio because a portfolio is not a plan. What if we took that same community, we provided further education while looking through their tax binoculars to help them understand the tax consequences of their decisions, right, about retirement planning and a whole bunch of other things, right? Just having a set of tax binoculars, right, in general. The tax binoculars would have absolutely been useful when they were making the decision about whether to put money in the tax-deferred bucket as opposed to the tax-free bucket. Imagine the wonderful decision that you could have made saying that you would put all the money in the tax-free bucket and not even having an issue with Uncle Sam. Imagine if from a Social Security, Medicare, long-term care, real estate, the sale, the purchase of it, starting a new business, understanding executive compensation and stock options, understanding being paid royalties, being a real estate investor. Imagine how you would be able to make better decisions about those areas when you were able to look through your tax binoculars? And what if we put your education alongside your planning and we did so at the fiduciary level of advice using the best interests of the client? In case you have just joined us, my goodness gracious, you are listening to another episode of Tax Smart Tax Zero, the path to the 0% tax bracket. And so with that being said, in our last few minutes before we go to break, let me introduce you to Sam and Susie, and of course their next door neighbors, Average Joe and Jane. So Sam and Susie are age 60. Let's look at their balance sheet, right? Because that's how we determine net worth. I've often said it before. If you make $500,000 but only have $100,000 of net worth, are you not in a worse situation than the person who makes $100,000 but has $500,000 of net worth? Can I even say to you, our favorite, right, is teaching people who make zero, right, according to their tax return, but have $1 million of net worth, right? Because if you understand what I'm talking about having money that is in your pocket, but is not on the 1040, i.e. the 0% tax bracket, right? Okay, so in our last few minutes before break, let me introduce you to Sam and Susie. Primary residence of fair market value $650,000. Rental property number 1, fair market value of $300,000. Rental property number 2, fair market value of $250,000. Sam has a 401k, $1.2 million. Susie has a TSP with $600,000 in it. Oh my goodness, it seems like Susie is under the old system, CSRS. Shh. Don't tell that to the FERS people, and goodness gracious, don't tell that to the CSRS offset people. Oh my goodness gracious. Okay, well, so we have said, right, what the assets are for Sam and Susie. I will say to you though, let me make this clear to you. Fact number 1, if you are listening to this show, it's because you have highly appreciated assets on your balance sheet, right? Fact number 2, tax-based estate planning is trust-based, right? So we will need to use one of the, we'll say 15 different types of trusts to achieve that purpose. It's not last will and testament-based, right? Fact number 3, tax-based estate planning is an active, not passive activity, right? So one of the things that I would encourage you to do to really understand this concept of tax-based estate planning, number 1, you can attend the webinar that we have. That's very basic, right? That'll give you the basics. But our Educational Estate Planning University, that's our course that you do over a 90-day period. And you do that because you want much, much more information and education. So I would say to you, if you're ready to take control of your assets and legally, ethically, and morally disinherit Uncle Sam from your life, right? And that of your spouse, and that of your children, and that of your grandchildren, you can give us a call. The number is 866-621-6660. Again, that number is 866-621-6660. I will say to you that COVID-19 has provided us clarity that we should expect the unexpected. But I also have to ask you, how hard is it to take 2 hours to write down your goals, right? I mean, people like to say they don't have time. You have nothing but time now, okay? You are working from home if you are working at all. Unfortunately, many people have had a family member pass away from coronavirus, right? And I have to say, I am tired of people saying that they are shocked about that, but then they do nothing to better their own situation. Every single person of the Tax Smart Tax Zero community has an ICE folder. If you want to know what an ICE folder is, that is in case of emergency folder, okay? That is something you absolutely need to have. So I'll say this. Sam and Susie have $1.8 million. Average Joe and Jane have the same amount. And so when we come back from the break, we're going to talk more about this tax-based estate planning concept. I will make sure that you understand in great detail what that is, because one of the things that you have to understand when we talk about this tax-based estate planning, we do so because specifically you have assets on the balance sheet that are tax inefficient assets. What do I mean by a tax inefficient asset? Well, goodness gracious, I mean the $1.8 million of tax deferred money, right, that both Sam and Susie and Average Joe and Jane have, okay? There's a 60-40 split between that money. Obviously, 60% belongs to them, 40% belongs to Uncle Sam. But we'll talk about the idea of this being a two-tier system so you can understand what I am talking about, okay? In case you have just joined us, you, of course, are listening to another episode of Tax Smart Tax Zero, the path to the 0% tax bracket. I am your host, Karen Scott Mims, affectionately known as your Tax ESQ, coaching you up to and through retirement each and every week. But for us, I've given you that definition of retirement planning, but I've also given you the definition, what we talk about in tax planning. It's about having tax-free wealth, and it's about being in the 0% tax bracket. When I talk about the 0% tax bracket, I'm talking about a 0% income tax, a 0% capital gains tax, a 0% estate tax, a 0% excise tax, and a 0% inheritance tax. That's the theme of our show always, but in particular, since today the theme of our show and the title of our show is The Last Will and Testament That Won't, introducing the concept of tax-based estate planning, I would urge you to stay tuned because we've got a ton of information that I'm going to share in the second half of the show. Don't go anywhere. We'll be right back.
Of all the questions you get asked every day, this is one you shouldn't ignore. How much money in your 401k or IRA is actually yours? Not what its current value is, but how much of it will end up in your pockets, not the government's. Remember, you still might owe taxes on that money. And how about tax efficiency? Are you overpaying, or are you keeping every dollar you're entitled to? Look, I know it's confusing, it's complicated, and it definitely isn't fun. That's why Harbor Point Wealth Management works to help make sure you aren't paying more in taxes than your fair share. They have a complimentary report to help make sense of taxes and how they can impact your retirement. Get it today. It's your money. You deserve to know what's at stake. Don't do the IRS any favors. Get your complimentary tax report from Karen Scott Mims and Harbor Point Wealth Management today. Just text the word tax to 301-900-5758. That's the word tax. Text it to 301-900-5758. Investment advisory services offered through Brookstone Capital Management, LLC, a registered investment advisor. BCM and Harbor Point Wealth Management are independent of each other.
Welcome back to the Tax Smart Tax Zero podcast. And now, your host, noted tax attorney and private wealth strategist, Karen Scott Mims, Esquire.
Hello, everyone. Welcome back to the second half of another episode of Tax Smart Tax Zero, the path to the 0% tax bracket. I am your host, Karen Scott Mims, tax attorney, registered investment advisor representative, estate planner, accountant, and certainly my favorite role, private wealth and tax strategist. Our show for today is entitled The Last Will and Testament That Won't, the concept of tax-based estate planning. So, in this half of the show, we like to call it tax liabilities and loopholes. And our focus is, of course, on legally, ethically, and morally disinheriting Uncle Sam, not only as the primary beneficiary of your 401k, 403b, 457, and TSP, but from all of the assets on your balance sheet, including the primary residence, including your taxable bucket, including your rental property or properties, and other highly appreciated assets. Now, if you believe in the concept, zero is my hero, we're talking about the whole idea of tax-free wealth and, of course, the 0% tax bracket when it comes to income tax, capital gains tax, estate tax, excise tax, and inheritance tax. Now, before the break, we introduced you to Sam and Susie, and they said that they wanted to engage in estate planning. Since Sam had unfortunately witnessed the death of his mother at age 80 from the coronavirus, and also, unfortunately, the death of his sister at age 52, again from the coronavirus. Now, it's interesting. Both women had been reasonably healthy in their minds, but Sam had to admit in our conversation that his mother had high blood pressure and cholesterol issues, and his sister had diabetes, right? So I think we can all acknowledge that compromised immune systems certainly represent a problem, right? I will also say that mom lived in the same house that she and Dad had purchased in 1970 for $60,000, it was now worth a fair market value of $900,000. It will come as no surprise to you that Sam wanted to sell and his sister wanted to keep it in the family. That might have been perhaps because she was living there and had lived there rent-free for her entire life. I think you get the picture. Hello, estate litigation and costly attorney's fees over an issue that could have been resolved much less expensively simply by having Mom complete her estate planning documents, right? Okay, so a reminder of the balance sheet for Sam and Susie. Primary residence, fair market value $650,000. Rental property number 1, fair market value $300,000. Rental property number 2, fair market value $250,000. Can I say to you that primary residence, debt service of $150,000, rental property number 1, debt service of $100,000. Rental property number 2, debt service none, 0. 401k for Sam, $1.2 million. TSP for Susie, $600,000. They have an IRS lien against that $1.8 million. Remember what I said? 60% belongs to them, 40% belongs to Uncle Sam, okay? No one likes to put that on their balance sheet, but it's there, okay? So while our focus is tax-free wealth and the 0% tax bracket, right, we achieve that definitely through tax planning, an additional layer on top of retirement planning. We also talk about education because here's the deal. Our philosophy is that getting to the path of, right, the 0% tax bracket or having tax-free wealth, it's built on the formula that you take expertise plus education plus planning plus advice plus strategy for a tax-free, stress-free, but certainly not scot-free retirement. My name is Karen Scott Mims. Thank you so much for joining us. Now, in this week's, by the way, Educational Essentials, can I introduce you to 2 terms for each of the 2 types of estate plans, right? So we have the last will and testament-based plan. That's going to have both the testator and the personal representative. And then if we have the trust-based estate plan, that's going to have the settlor and the trustee. Mind you that for the last will and testament, the testator is the person who owned the assets, right? The personal representative will be the person who's going to be in charge. The same concept applies to the trust-based estate plan and to a trust. Settlor is going to be the person who owns the assets, right? The trustee is going to be the person whose job is to administer the plan. So in our last few minutes, I know you're probably saying, why tax-based estate planning, right? Well, when I sat down to speak with Sam and Susie, I asked them, what are the 5 goals that you want to achieve, right, by having estate planning? They said, number 1, we want to avoid probate. Understandable. Number 2, we want to avoid the publicity of their business and any of their documents. Understandable. Last will and testaments, right, are public documents. Number 3, avoid and protect the assets from any beneficiaries who would likely mismanage Sam and Susie's money, since those beneficiaries are currently mismanaging their own money, right? Number 4, avoid and protect the assets from any other non-favored potential beneficiary, right? They're really talking about their Sam and Susie's daughter and the pending divorce that they see in her future. So divorce, creditor, liens, judgment, right? All those things that might happen in the future. But number 5, they wanted to implement a method in which Uncle Sam and taxes did not eat up the majority of the estate before being passed on to the beneficiary. When I asked them to rate that on a scale of 1 to 10, number 10, right? It was number 10 on their scale, right, of concerns. So all of these reasons require that we use this trust-based estate plan, right, because the last will and testament plan is simply not sufficient. Especially when you have an asset like tax-deferred money, right? That means that we really have to have extra and specialized planning, i.e. tax-based estate planning. Now, once again, our goal, right, is to legally, ethically, and morally divorce Uncle Sam because we want tax-free wealth. We certainly want to be in a 0% tax bracket. And so I ask you, wouldn't it be great if you lowered your tax liability for yourself during your own lifetime, right? We're going to do the tax-based estate planning, but let me just ask these questions. Question number 2, wouldn't it be great if instead of having your Social Security taxable, you received your full benefit, right? 32% higher because they waited until, right, 4 years beyond full retirement age to receive it, right? They waited until age 70. Wouldn't it be great if you had your entire Social Security benefit free from taxation, right? Wouldn't it be great if the $1.8 million of tax-deferred money became $1.8 million of tax-free money during their lifetime to use for their own benefit? And I think the answer is yes, right? I mean, of course, that sounds like a wonderful idea. Well, as you can imagine, Sam and Susie took one path, and average Joe and Jane took another path, okay? Sam and Susie did both. They achieved their goals of legally, ethically, and morally divorcing Uncle Sam. The $1.8 million of tax-deferred money grew to $3 million of tax-free money. They never paid any more taxes on their Social Security benefits. We structured the portfolio so that all of the growth now went in their pocket tax-free, but not on the 1040. They became smarter about how to get extra tax benefits from the real estate holdings, right? They were able to sell them without incurring large capital gains, because that's what happens. A lot of people stay and remain landlords even though they don't want to anymore, right? Because they fear the capital gains. Don't worry about that. We are all about conquering capital gains. They became smarter about using charities, right, as part of their tax planning. And in particular, they stopped using this checkbook philanthropy, right? I always say that there are two tax systems, one for the informed, i.e. the wealthy 1%ers, and one for the uninformed, okay? I would say choose the former and not the latter. And I would even say if you could just take some time to attend, right, maybe the webinar, attend our estate planning university, just even have, right, one of the complimentary consultations. Will put together a plan for you. But I have to say, involving charity and understanding charitable and philanthropic planning would really make the difference, right? That's one of the things, certainly, that one of the components that we go through in Estate Planning University. In case you have just joined us, you, of course, are listening to another episode of Tax Smart Tax Zero, the path to the 0% tax bracket. In the last few minutes, let me say this. We talked about, right, this being a two-tier system. Why do we need tax-based estate planning? Because there's a two-tier system. When you do that 60-40 split, 60% belongs to you, 40% belongs to Uncle Sam, right? So that 60% that you allege, right, and claim is yours during your lifetime, can I say to you that you need to realize that Uncle Sam is going to take an additional percentage before it goes to your beneficiaries, right? Because there is no step up in basis on tax deferred funds. So I have to say, I don't mean to sound like Oprah, but you have a tax partnership with Uncle Sam. Your spouse has a tax partnership with Uncle Sam. Your children have a tax partnership with Uncle Sam, and your grandchildren have a tax partnership with Uncle Sam. Now, I did not say that Oprah should break up with Stedman. No, that is not what I said. I said you should break up with Uncle Sam, legally, ethically, and morally disinheriting Uncle Sam. That's the point that I'm making. In case you have just joined us, golly, Wally, where does the time go? We are wrapping up another episode of Tax Smart Tax Zero. Our show for today was entitled The Last Will and Testament That Won't. It is an introduction to the concept of tax-based estate planning. And I would say to you in the last few minutes that we have left, if you are age 55 or older, if when you put together your balance sheet, you have, right, maybe all of those 5 taxes that we've talked about, right? Maybe you are subject to income tax. Absolutely you are. You have tax deferred money. Capital gains tax. Absolutely you are, right? So income tax, capital gains, estate tax, excise tax, and inheritance tax. Those are the 5 fingers of death that I like to call them, right? And what we're about is, again, this is a show about not just plain old retirement planning. It is about tax planning, right, as an additional layer on top of that retirement planning. Because what our clients are trying to do, what our listeners are trying to do out there, they're trying to have tax-free wealth, right? That's the best kind of wealth, right? Tax-free wealth and the path to the 0% tax bracket, meaning that that wealth belongs in your pocket. It can absolutely be shown on your balance sheet, but it is not going on the tax return. So, with the last few minutes that we have left, I will give our number, 866-621-6660. Again, that number is 866-621-6660. If you would like to attend the webinar that I talked about, that will give you, the basics of estate planning. I would probably say that you need to attend that 90-day course that we have, Estate Planning University. Again, the number is 866-621-6660. If it's easier for you to text the word estate to 301-900-5758, do that as well. Or you can always send an email to seminar@TaxSmartTaxZero. Well, where does the time go? Thank you so much for joining us today. Barbara, if you've joined us, get back to work.
This concludes another episode of the Tax Smart Tax Zero podcast. Get ready to create tax-free wealth and start on the path to the 0% tax bracket. To receive your Tax Smart Tax Zero toolkit, you can reach us by telephone at 866-621-6660 or text the word TAX to 301-900-5758. Or send an email to tax@taxsmarttaxzero.com. Want to attend our virtual seminar, Guide to Tax Minimization, Estate Planning, and Passive Real Estate Income? Text the word seminar to 301-900-5758. Send an email to seminar@taxsmarttaxzero.com and we'll register you and also keep you updated of all future virtual seminar dates and times. Don't forget to visit taxsmarttaxzero.com and on our YouTube channel. There, you can like us and subscribe to learn more about our tax study group, Zero is My Hero, or attend our upcoming webinars. Follow us on Facebook, and as always, sign up for our monthly tax newsletter and divorce Uncle Sam as the primary beneficiary of your wealth. Join us next week for another episode of Tax Smart Tax Zero, the path to the 0% tax bracket.